Gentlemen, I need you to stop refreshing the price chart. I need you to stop screaming into your pillow. And I definitely need you to stop texting your wife telling her that we are going to have to sell the dog to cover the margin call. The dog is safe. You are safe. But the chart you are looking at, that is not safe. That is a crime scene. If you are looking at the screen this morning and seeing red, if you are seeing silver smash below $90 and gold taking a nosedive and you are feeling fear, then I have bad news for you. You have fallen for the trap. You are looking at the puppet show while the theater is burning down behind you. Because while the price on the screen says crash, the data coming out of the vault says bank run. Ladies and gentlemen, I am the Asian guy. It is Saturday, January 31st, 2026. It is the end of the month. It is the end of the week. And the powers that be decided to throw a party. They invited the price of silver to a red wedding. They took it out back and clubbed it like a baby seal from over $120 to under $90 in 24 hours. To the uninitiated, this looks like the end of the world. It looks like the bubble popped. But if you wipe the tears from your eyes and actually look at the ledger, if you look at the delivery notices that were issued this morning, you will see something that defies all logic. You will see something that proves this price crash is not a sell-off. It is a desperate, failed attempt to stop a nuclear explosion. But here is the smoking gun. Here is the piece of evidence that proves beyond any doubt that this crash was manufactured, coordinated, and executed with surgical precision. When the price hit $90, when the screen turned red, when every rational investor on the planet had the same thought, by the dip, something happened that should not happen in a free market. The buy button disappeared. You picked up your phone. You opened the app for JM Bullion. And what did you see? Did you see a buy button? Did you see a confirmation screen? No, you saw an error message. You saw a spinning wheel of death. Or you saw a polite little notice saying the site was down for scheduled maintenance. Scheduled maintenance on a Friday morning during the most volatile trading session in history. Do you really believe that their IT department decided that right now, in the middle of a market crash, was the perfect time to update the server software? Please, I have a bridge in Brooklyn to sell you. This was not maintenance. This was a circuit breaker. The dealers pulled the plug. And it was not just JM Bullion. Reports coming out of London indicate that the LBMA electronic matching systems went offline due to technical difficulties right as the smash began. The London Bullion Market Association, the single most important silver trading hub on planet Earth outside of New York, offline at the exact moment the price was crashing. This is not a coincidence. This is coordination. This is the $90 trap. And I am going to prove it to you with data, with evidence, and with math that even the most skeptical person cannot deny. So buckle up, focus, and let me show you exactly what happened in the last 24 hours, because what you are about to hear is going to change everything you think you know about the silver market. Let me start with the timeline, because the sequence of events is the first clue that this was premeditated. On Wednesday, January 29th, silver hit an all-time high of $120.46 per ounce. The market was euphoric. Retail investors were celebrating. The mainstream media was running headlines about silver's historic rally. Everything looked perfect, too perfect. Then, on Thursday night, after the Asian markets had closed, after the European markets were winding down, after most retail investors were asleep, the CME Group made an announcement. They were raising margin requirements on silver futures. Again, this was the second margin hike in less than a week. On Tuesday, they raised margins from 9% to 11%. Now, on Thursday night, they announced another increase to 15%. For those who do not trade futures, let me explain what this means. When you buy a futures contract, you do not pay the full value up front. You put down a margin, a deposit that represents a fraction of the total value. If you have a $100,000 position and the margin requirement is 9%, you need $9,000 in your account. If the margin requirement jumps to 15%, you now need $15,000. And if you do not have that extra $6,000, you get a margin call. The broker says, deposit more money right now or we will liquidate your position. This is how they shake out the small speculators. This is how they force retail traders to sell. Which meant that when the market opened on Friday morning, traders knew that higher margins were coming. They knew that if they held their positions over the weekend, they would need significantly more capital, and many of them made the rational decision to reduce their positions ahead of the margin hike. This created selling pressure. Before the margin hike even technically went into effect, the CME did not have to force liquidations. They just had to announce that liquidations were coming. And the traders did the rest themselves. This is psychological warfare. This is market manipulation disguised as risk management. But the margin hike was just the opening act. The real fireworks happened on Friday morning, January 30th, the last trading day of the month, and not just any month. This was the end of January. This was the day when banks have to mark their positions to market for regulatory reporting. If silver closes the month at $120, the banks that are short silver are sitting on billions of dollars of unrealized losses. Their capital requirements go through the roof. Their risk managers start screaming. Their regulators start asking uncomfortable questions. But if they can smash the price down to $90, even for just one day, just for the closing bell, their books look magical. The losses shrink, the capital ratios improve, the regulators smile and walk away. This is called window dressing. It is a game as old as Wall Street itself. You manipulate the price at the end of the month or the end of the quarter to make your balance sheet look prettier than it actually is. But here is the thing about window dressing. Usually it is subtle. A few dollars here, a few dollars there. You nudge the price in the direction you need it to go. You do not smash it by 30% in a single session unless you are desperate, unless you are facing existential losses, unless the alternative is admitting to your shareholders and your regulators that you are technically bankrupt. The violence of Friday's crash tells you exactly how bad the bank's positions were. They did not have the luxury of a gentle nudge. They needed a sledgehammer, and they swung it with everything they had. Now let me show you the numbers, because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. At 8:30 a.m. Eastern Time on Friday, silver was trading around $118 per ounce. By 10 o'clock a.m. it had dropped to $99. By noon it had crashed through $90. By the end of the session, some dealers were quoting prices as low as $76, a drop of over 30%, over $38 per ounce. In a single session, this is the largest single-day percentage decline in silver since the Hunt Brothers squeeze collapsed in 1980. Let me put that in perspective. For 45 years, we have not seen a move this violent, not during the 2008 financial crisis, not during the COVID crash, not during any of the countless market panics and corrections and bear markets that have happened over the past 4 decades. Friday's crash was a generational event, and the mainstream media wants you to believe it was caused by a stronger dollar and hawkish Fed comments. Give me a break. The dollar index moved by 0.9%, less than 1%. That is noise. That is not enough to trigger a 30% crash in silver. In fact, if you look at the historical data, there is no correlation between a 0.9% move in the dollar and a 30% move in silver. None. The correlation does not exist, because the dollar move did not cause the silver crash. The silver crash was manufactured, it was engineered, and the dollar move was the cover. Story, here is what actually happened. At precisely 8:30 a.m. when the New York market opened, a massive wave of sell orders hit the COMEX. We are talking about billions of dollars of paper silver dumped onto the market in the first few minutes of trading. The volume was so extreme, so concentrated, that the price could not absorb it. It just fell straight down. No bids, no support, just a vertical red line on the chart. Now, in a normal market, when prices fall that fast, arbitrage traders step in. They see a bargain and they buy. They see the price diverging from fair value and they close the gap. That is how markets are supposed to work. But on Friday, the arbitrage traders were locked out, because here is the dirty secret. You cannot arbitrage between paper and physical if the physical market is closed. And on Friday morning, the physical market was effectively closed. JM Bullion went down for maintenance at the exact moment of the crash. APMEX was reporting delays. SD Bullion was overwhelmed with orders. The major online dealers, the places where retail investors go to buy physical metal, were either offline or so backlogged that placing an order was practically impossible. And in London, the LBMA electronic systems experienced technical difficulties. The matching systems that connect buyers and sellers, the infrastructure that allows the London market to function, went dark. Reports indicate that the outage lasted for a critical window during the crash. Long enough to ensure that Asian buyers, the Chinese arbitrageurs who have been vacuuming up physical silver at massive premiums, could not step in to stop the fall. By killing the connection, the Western banks ensured that there was no bid to catch the falling knife. They created a vacuum, they cleared the order book, and the price could free fall to $90, then $85, then $80 without hitting any resistance. This is the definition of a rigged market. When the price goes up, they hike margins to stop you. When the price goes down, they turn off the websites to stop. You heads, they win. Tails, you lose. But here is where the story gets really interesting. Here is where we see the fingerprints of the cartel all over the crime scene. Friday, January 30th was not just the end of the month. It was also first notice day for the February COMEX silver contract. For those who do not trade futures, let me explain what this is. It is the day of reckoning. It is the day where contract holders have to make a choice. Choice A, you roll your position. You sell the February contract, and by the March or April contract, you kick the can down the road. You stay in the paper game. Choice B, you stand. You do nothing. You let the contract expire. And by doing nothing, you are legally demanding that the exchange give you the physical metal. Usually when the banks smash the price right before first notice day, they do it to scare you into choice. Say they want you to run away. They want you to roll over. They do not want you to take the metal. So they smashed the price. They painted the tape red. And what happened? Did the longs run away? Did they panic? Did they sell their contracts and flee to the safety of cash? No, they stood their ground. They crossed their arms, looked the banks in the eye and said, I do not care about your price. Give me my metal. The official data from the CME Group has just been released. On first notice day, 1881 delivery notices were issued for the February silver contract. Each notice represents 5,000 ounces. Grab your calculator, but here is the smoking gun that proves the crash was a bear trap, not a real sell-off. The smart money did not short in any normal market crash when the price drops. 30% in a single day, the speculators pile in on the short side. The hedge funds smell blood, the algorithms detect momentum, everyone wants to ride the crash to zero and make money on the way down. That is how markets work. When something is falling, traders short it to profit from the fall. But on Friday, something strange happened. The short interest in SLV, the biggest silver ETF in the world, did not spike. We checked the prime brokerage data. The fee to borrow shares of SLV is sitting at 0.53%. That is basically free. That is rock bottom. And the number of shares available to borrow, there are over 10 million shares sitting there collecting dust. Nobody wants them. Nobody is borrowing them. Nobody is shorting. Do you understand how insane that is? The price just dropped 30%, a historic collapse. And yet the speculators are refusing to bet against the metal. Why? Because they are not stupid. The hedge fund managers in Greenwich and Mayfair are looking at the same global map we are looking at. They see the $132 price in Shanghai, they see the $118 price in Mumbai, and they see the $90 price in New York. And they know that shorting silver at $90 right now is like standing in front of a freight train and holding up a piece of paper that says stop the